So this is a new stock to the show. We haven't talked about this one before, and I'm going to resist the urge to say it in Laszlo Cravensworth's accent, but it's Manhattan Associates, and it's MANH is the ticker it trades on the Nasdaq. It's I mean, to me, when I was skimming across this, I thought, well, that's obviously a REIT, and didn't really spend an awful lot of time looking at it. But it kept popping up in my when I was running screeners, and I thought, well, it's obviously because the REIT metrics are always funny. It's obviously keeps popping up, but it's not a REIT. It's a software company, Steve, and I think it's a very, very interesting software company. So when we talk about companies like following the Adobe trend of being a sort of license seller and swapping to a software as a service kind of company with a recurring revenue. We have another one to add to that list of companies to watch doing it. And the market was a little bit worried about these earnings coming into them. And the top line didn't look too great, but when you dug into the report, it got a lot better. And unfortunately, the stock that has been on my watch list for about 7 months, waiting for me to actually do some proper research into it, jumped up about 8.5%, Steve. So what do? They basically help businesses manage and improve supply chains. Their technology makes it easier for retailers, manufacturers, logistics companies to track inventory, manage warehouses, fulfill orders efficiently, and get all these systems to talk to each other. It's essentially a cloud-based software, but also can be on-prem if you want it on-prem. And basically helps customers with big long supply chains reduce costs, deliver products faster, which is obviously really important when online shopping and quick delivery and Amazon has set the bar for that, and you need to catch up. Customers are about as big as they get, Steve. It's Walmart, Home Depot, FedEx are three of its larger customers. At the moment, like I said, it is shuffling these customers over to cloud subscriptions, which is going to create more predictable revenue for them. They're also focusing on a bit of innovation at the moment, using AI, data analytics to help business better predict demand and optimize operations. They're pretty much a leader in the supply chain technology, and they think that they're an essential piece of software, to help customers, help companies meet customers' sort of growing expectations across store and online, and again, mostly driven by Amazon and the things that they do. It's about $13.4 billion in market cap, so it's not a massive company by any stretch of the imagination, and to have customers as illustrious as that, I think is pretty interesting. So this was Q2 2025 because they're sensible. And these are the figures that we got. So the revenue was 272.4 million. That was only up 3% year on year. But here's where I think it matters. Cloud subscription revenue was 100.4 million, and that's up 22% year over year. Adjusted EPS is actually a decent metric for them, though, because they are adjusting that to show you the difference between the two sides of the business. And if you adjust it, you'll see that they grew it by about 15.9% versus consensus. They came in at $1.31, and they've got about $2 billion of remaining performance obligations, and that's up about 26% year over year. The operating margin is about 35%, and they expect that to continue going into Q3. But yes, strong growth driven by new customer adoption. There's a smaller proportion of on-premises now. They're saying that's stable, which you can see with the revenue at the top. But they're trying to push cloud-based, and you can see that in the key customer wins. About 70% of new business in this quarter was cloud recurring revenue business, and net new customers as well. A 70% win rate against their competitors, and their competitors just to compare a SAP, Oracle, and IBM. So 70% of the times they're up against them, they win. So I thought that was That was pretty good. In terms of full year revenue, they said that about just over $1 billion to nearer 1.1 billion is what they're expecting. That was actually raised. They said adjusted EPS for the year will be about $4.80, which was also raised. Q3 revenue will be about 270 to 272 million, so a very tight range. And again, operating margins of about 35%. So yeah, I thought there was really strong momentum in the cloud business here, Steve. I thought it was really interesting to see it growing at 22% year over year. I think they're showing signs of this successful transition from on-prem to SaaS. And if it gives it more predictable revenue, it might be easier for you to model this one out from there onwards. Good cost management as well, operational efficiency and scalability of this cloud offering. You can see that in the operating margin, 35%, very good. And RPO obviously exceeding 2 billion, increasing 26% year over year. Huge backlog of contracted revenue, solid visibility into their earnings, pretty strong demand showing for Manhattan's platform as well. And also the 70% win rate really jumped out to me, Steve, against major ERPs and client software rivals. The problem with those companies is they do a little bit of everything. And I think Manhattan is like sort of laser focused on being the masters of this kind of supply chain management and supply chain execution. And its market share is improving every month. They talked about having a big strategic investment in sales and marketing, basically hiring talent. They want to accelerate cloud adoption and also continue expanding market penetration. They reckon that this their ability to successfully hire and onboard talent is pretty critical in this competitive market, and it's kind of listed as one of their risks as well. So depending on how you feel about them attracting these people, it's probably change how you feel about the business. They said that they're increasingly integrating AI and machine learning capabilities into the platform, and that's expected to drive operational efficiencies as well as deliver more intelligent, automated supply chain solutions for customers. And one of those things is, which we talk about Amazon, they can kind of guess what you're going to buy in a specific area and move them into closer warehouses. So when you buy them, you get the sort of double whammy of it being a faster delivery, and also Amazon saves money because it doesn't have to, rapidly pick, ship, and move something into a couple of warehouses before it gets to you. So this is something that Manhattan Associates can do as well. They raised full year revenue and earnings guidance, reflecting pretty good confidence in the management, continue to grow, fueled by what they're seeing in cloud subscription strength and obviously the expanding customer base. On the day, Steve, shares jumped about 11%, but then they've kind of slipped back a little bit, but still up over 8%. I think there's a lot of enthusiasm about this company at the moment. I think it's one of the maybe under the radar good companies that we see in America, and I'm still pretty interested in it, Steve. If we go back to its IPO, it's been a fantastic winner. Actually launched back in 1998, had a little jump up in the tech boom to about $16.50. Fell all the way back down to like $3, and it stayed around the sort of $3 to sort of $8 mark for a very, very long time. Since then, Steve, it's been a 35x. It's now at $221, so 35x in the last sort of 15 years. And I don't think that's gonna stop, Steve. I think we're still only at 13.5 billion. Kind of company. The CEO has been in place for about 12 years now. It sounds like he still really likes the job as well. And I think there's a lot of space for this company to run into. Steve, have you heard of this company before?
No, I had a little look the other day when you mentioned it, and there were some interesting things that jumped out at me as well. One reason we tend to be wary about these, which is something that you didn't mention, but you could have done, is that these software companies generally have pretty high stock-based comp numbers. And so when you try and look at them on a kind of free cash flow basis, you look at a price of free cash flow number and you think, that looks all right, or that looks a bit high, or hey, that looks quite low. In the case of something like PayPal, and then you realize that actually nearly all their free cash they're using either giving away in stock-based comp or using to buy back their stock-based comp, leaving you with nearly nothing in the first place. And a good sign that that's happening is that the share count goes up over time, basically, because instead you hang on to all your cash, great. And we've been advocates before, in fairness to these kind of companies, of the idea that, well, if your share count goes up, but your revenues, profits, and free cash flow go up faster, you're doing the right thing. Probably anyway, assuming there's not a way for you to make it go up without the rising share count. But there isn't always. And so what you might think in this case is we're expecting to see something similar here, because we've seen free cash flows go up pretty impressively. They've close to tripled according to QuickFS over the last 10 years. They've gone from about 109 million or so to 308 million ish, and the share count has gone down, which means that you're in a way better position here. But it's not because they don't have stock-based comp costs. They do. They produce about 316 in operating cash flows. These are slightly backdated here numbers. And then send out about 100 of that, about a third of it, in stock-based comp, and then they buy it all back again, and then they buy back some more, and their share count goes down and not up. And I think that's really impressive here. So that's encouraging. Aside from that, I was looking for sort of standardish things like market positioning, as you point out. There's kind of a handful of these companies that together seem to run the show, and maybe they consolidate over time, or maybe they don't, because it looks like most of them actually fare pretty well. This is the kind of slightly distinctive one. I think there's more than one that has a kind of a niche focus here. I heard one of the Salesforce cloud things as a candidate competitor to part of the business, which is exactly an example of the kind of thing that you mention here, which is probably not quite the benefits of a focused organization. Sometimes when we look at companies, we look for both the benefits of scale and the close relationships with customers, expertise, specific sector knowledge that comes with this being your kind of main thing that you are paying attention to. Hard to find both in these cases, but Manhattan is very much focused on this part of its business, and its churn rate is very, very low. They don't publish an official one, but they hang on to about 95% of their business, which is pretty darn high. And you point out they have a pretty good win rate against competitors. So a lot of the kind of stuff you would be looking for here. The financials go a bit wobbly in places because, like you say, signing up, we've talked about this several times now. See any previous episode where we've talked about Celebros or Guidewire or any other kind of tech stock. But this has a feel of the kind of organization that I like in principle, which is to say, I like specialist software things. I quite like your Tyler Technologies, which is government software, and I quite like Blackboard in principle, though it appears to be doing an awful job in a not massively popular sector, which is non-profits, and so on and so forth. So I'm interested to find one here in what clearly appears to me to be in a very good sector, which is not just CF, Guidewire, a necessary sector, that's insurance. This is a growing sector, which is basically logistics and e-commerce and supply chain management and distribution and all that kind of thing. And if you liked REITs, or that kind of REIT, and you put a premium on that kind of REIT as well, you might. Plenty to like here in terms of something that also stands to benefit from that, but with more attractive margins than your average REIT, I think, Steve. Returns on invested capital, returns on equity, you expect them to be high from a software company, but my word, they are high in the case of this thing. They are double digits is, well, strictly true, but there's a lot of double digits, and not many of them are as high as this. They're like mid to high double digits, which is something we nearly never say on this. It's not quite right move territory, but it's sort of thereabouts, Steve.
Yeah, it is. ROIC, I think, is about 41.5%. I think the last time I saw it was pretty incredible, pretty incredible number. And the margins across the board are really good as well. Free cash flow margin like 29.1%. Is really good conversion. I think they've got a pretty decent sized moat as well, Steve. I think we'd call it the switching costs moat, mainly because they get the tendrils in. Basically mission critical infrastructure. They usually set it up, provide the services for it, and when you get to a certain size, you've got to be a braver man than me to want to rip out critical infrastructure like that in favor of something that you're not entirely sure will work straight away. I mean, can you imagine Walmart, for example, ripping it out into something that didn't work for one day? It would be catastrophic. So I'm still really interested in it, Steve. I don't think it's I mean, when I saw it had gone up about 8%, I had this feeling in my head that it was a much bigger company than than I thought it was. And when I look back into it again, I thought, wow, this is a pretty interesting looking company doing some really interesting things. If they can keep this this sort of innovation going and keep fending off competitors, I think they're going to do really, really well. So yeah, I would encourage everybody to go and have a look at it and listen to the call, listen to them talk, and then let us know what you think, really, because I think this is something that I've not seen anybody talk about really anywhere else. And it may be a little bit about the size, it may be a little bit about going under the radar, but it looks like a fantastic business. Be interested to see if anybody has any first-hand experience with it as well.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.